As you've just seen and heard, I think this meeting is recorded and we'll be posting the recording on the website later for you to pass on to colleagues and peers who may not have been able to join at this time. So we're just going to go through, obviously, the presentation of the key findings of the report, followed by a panel discussion. So we're really glad to welcome our three panelists here today. Gabrielle Wilson-Otto, Director for Sustainable Investing from Fidelity International, Wai Leng Leong, Managing Director and Regional Head of Asia Pacific for CDPQ Global, based in Singapore, and Michael Salvatico, Head of Asia Pacific, Middle East and Africa, long title, of ESG Solutions for S&P Global Sustainable One. So thank you very much for the panel for joining today. So I'm just going to make some, just for those of you who may not be as familiar with AIGCC, if we could just go on to the next slide. Thanks. Yeah, just to mention that AIGCC has been growing really steadily over the last 5 years since we relaunched as a member initiative. And our core offering is to support investors in their implementation of climate risks and opportunities into their portfolios, and to help them understand the rapidly evolving regulatory and policy landscape that we're seeing in the region around climate implications for investors. So we're providing tools and resources to support all investors in Asia, wherever you may be in your journey of implementation and integration, help you move as fast as the markets and the science is increasingly demanding. The work we do is produced and led by investors for investors to ensure that it's relevant and fit for purpose. And we're supported by a team of 13 across 6 markets, which is really exciting to see the growth of the team. And I hope you've had an opportunity to interact and work with all of the team members, wherever you may be based. I'm really excited to present this report to you today. It's really important to help us measure the progress of investors year on year. And one of the key findings that I was quite interested to see is the increase in the use of the new frameworks that are being used. And this is incredibly encouraging. AIGCC has been a founding partner to a number of these new frameworks and initiatives. And I think, and I hope that this demonstrates how we are collaborating at a global level with our network peers, but importantly to help gain consensus and to identify areas of convergence at a global level and bring that back to the regional perspective around the increasing expectations of investors, and help you to do that implementation at whatever phase, or heading into obviously the ultimate net zero alignment. So with that, I'd like to hand over to Firdaus Anwar, who's going to take us through the findings of the report. Thanks very much, Fid. I think you're just on mute there, that classic of Zoom. Not yet, no.
Sorry. Okay. Thank you, Rebecca, and thank you for everyone for participating in today's webinar. And my name is Firdaus Anwar. I'm a project manager for AIGCC, and I'm based in Tokyo. So for the first session today, I will present the key highlights from our most recent net zero investment report published in the last 2 weeks, titled Pursuit of Ambitions, Net Zero Investment in Asia. This is the third time we are publishing a report about net zero investment in Asia. And it's written based on the survey results taken in the end of last year, where we received over 20 responses from a range of asset owners and managers with asset under management over $6 trillion. So the survey is aimed to better understand and align investment in Asia, taking a snapshot in time for investors' sentiments, and to understand factors driving investors' thinking and behavior. And for all this purpose, we further provide valuable insights to AIGCC work in the following year. So the report can be accessed from publication section in the AIGCC website. So more about the survey behind this report. This slide will show you the range of topics we asked in the survey, which includes what kind of methodology and definitions used to define climate-aligned investment, and what is the status of current implementation of net zero investment strategies used across both markets and asset classes, how the impacts from climate-aligned investment are measured and monitored, and what are the remaining barriers to increase the climate-aligned investment. And on top of this topic, we also add 2 new topics about new international climate initiatives, as mentioned as Rebecca just now, and also climate voting to further add more color in understanding investment trends in Asia. So as for the main insights of the report, there are 4 main headline insights, which the first one is Asian investors embracing new international climate frameworks. Secondly, the interim targets, a part of setting a net zero emission targets, are becoming a key component to the net zero commitments among investors. And on investment strategy, focus on corporate engagement remains strong, with voting on climate getting more popular, and measuring green impact continues to be one of key barriers to increase climate-aligned investments. I will further deep into details of each insight in the next slide. And let's go for the first insight of the report, where Asian investors embracing new international climate frameworks. We found that more methodologies being developed in 2021. While in previous years, investors had relied on third-party ESG data service providers, but recent survey results showed that, for example, Net Zero Asset Managers Initiative is the most used methodology with 60% respondents, followed by the third-party ESG data service providers with 35%, as displayed in the graph here. And Paris Aligned Investment Initiative has the third most used methodology with 30% of respondents. So the next slide is still on the first insight about Asian investors embracing new international frameworks. This slide will show you the graph about the tools and frameworks investors use to implement climate-aligned technologies. And not surprisingly, you can see here that TCFD recommendation is the most used tool investors are referring to, similar to previous year results of the survey. And surprisingly, another investors agenda, Investor Climate Action Plan, ICAPS, comes in second, and Climate Action 100+ Global Sector Strategies comes in third as the most tools used by investors in Asia. Both ICAP and Global Sector Strategy is a new addition to the survey this year. And so ICAP is a framework developed by the Investor Agenda to guide investors with clear expectations for issuing and implementing comprehensive climate action plans, including steps investors can take to support the goals of a net zero emission economy by 2050 or sooner than that. So let's go for the second insight. It's about interim targets are emerging as a key component to net zero commitment. This graph shows the proportion of investors setting a net zero emission target by 2050, where the dark green bar represents the whole portfolio for multi-asset class only, and light green bar represents specific asset classes. 40% of respondents have made portfolio-wide commitments, with 20% of respondents have also made specific asset class commitment to net zero emissions by 2050. So it is also very positive to note that over 45% of respondents although haven't made portfolio-wide commitments yet, but actively considering to make such commitments in the next years. And next on insight, second insight is on interim targets. This is the graph. This graph shows about the proportion of investors who have set an interim target to reduce emission across portfolio by 2025 or by 2030. Similar to the graph in the previous slides, the dark green presents the whole portfolio for multi-asset class, and the light green shows the specific asset classes. And it's very, very interesting to note that high proportion of respondents, 25% have set a portfolio-wide interim target, while 55% are actively considering to do so. Respondents have also made a remark that many has publicly disclosed their target and attributed these results to the support from initiatives such as Net Zero Asset Managers Initiative, where AIGCC is supporting as one of their network partners. So we'll go for the third insight, which highlights that the focus on engagement as an investment strategy remains strong. And a new addition this year about voting on climate is an emerging theme. So this slide shows a graph of year-to-year comparison of implementation of the climate-aligned strategies among investors, where dark green shows 2020 results, a survey result, which is the previous years, and the light green shows the recent survey result in 2021. So in 2021 survey, corporate engagement and shareholder action continues to be most popular climate-aligned strategy in Asia, with 70% of respondents chose them. With that strong emphasis on corporate engagement, we feature some case study in the report to highlight the importance of active engagement by investors in Asia. Negative screening is the second most popular choice for climate-aligned investment strategy in 2021, 50%, which is similar to previous year, which similar to previous year, and more popular than positive and in-class screening. So voting policy on climate, which is a new addition on the survey this year, is the third most popular strategy among Asian investors. Follows a globally rising phenomenon. And another finding is we found a steep decrease in response to decarbonization strategy, which from previous year 68% to 35%, and portfolio tilting from 47% in the previous year to 10% in 2021, which might show a signal that rather than divesting their high carbon assets, investors are focusing on emission reduction over a pledged timeline. And the last insight, and insight 4, measuring green impact remain a key barriers to further climate-aligned investments. The graph here shows perceived barriers to increasing climate-aligned investments in 2020 and 2021. So it's a year-to-year comparison, and similar to last year, lack of tools to measure green impact continues to be identified as barriers to increase climate-aligned investment among investors in Asia. 45% responded compared to 55% in previous year, which is interesting to note. Lack of tools to measure green impact shows that investors are aware of the risk of greenwashing in their investment portfolios. Lack of client demands is the second barrier. Sorry if the graph is a bit difficult to see, but yep, lack of client demand is the second barrier noted in the 2021 survey, with 50% of respondents and 25% of respondents chose policy and regulatory uncertainty as a barrier, which is the third choice. And the most recent survey shows the policy barrier as a declining result, which is somehow positive to see and signal that investors have made a slight shift in their strategy in managing policy and regulatory uncertainty in investment activities for investors in Asia. So more details such as case study on target settings, engagement, and other trends are available in the report. So with this, I'll end my presentation, and I'll pass the floor to Jane Ho, our Director of Investors Practice, to continue with the second session, the panel discussion. Thank you.
Thanks, Ferdas. Can we stop sharing the slides, and I'll just introduce the panel quickly. Thank you. Hello, everyone. I'm Jane Ho. I'm the Director of Investor Practice for AIGCC, and I'm very pleased to be moderating our panel session for today. So as a way of firstly introducing the panel, we have Long Wai Ling, the Managing Director and Regional Head of Asia Pacific CDPQ Global, based in Singapore, but I think Wai Ling's in India today. Wai Ling is responsible for the regional management of CDPQ Global, including responsible investing. CDPQ has had a strong focus on climate since its first climate strategy was set out in 2017. So I'm very glad that she can join us today to talk about some of their latest initiatives. Secondly, we also have Gabriel Wilson Otto, Director of Sustainable Investing at Fidelity International. Gabriel works on integration of sustainability considerations into investment processes, and also helped to develop Fidelity International's proprietary sustainability ratings, which is one of the case studies that we featured in the report. And last but not least, we have Michael Salvatical, who leads ESG solutions in Asia Pacific, Middle East, and Africa for S&P Global Sustainable One, joining us from Sydney today. And Michael works on sustainable solutions for investors, banks, corporates, regulators, governments, and academics. I'm very happy that he can join us today to share his insights. So we've just heard from Ferdas about AIGCC's survey, which is a stock take on the current climate investment landscape in Asia. So I just want to start by going around the virtual room here. If everyone could share or comment on a key trend from the report that resonates with you, or any others in Asia that you see on the ground that you believe is really important. So starting firstly with Wai Ling, please.
In terms of my feedback on the survey results and what resonates, I think climate or actually ESG, really resonates with CDPQ in a very big way. So, just to share, we set our climate strategy way back in 2017. And I think it's perhaps quite interesting that we have also chosen to tie our variable bonus, our variable compensation to carbon intensity of our portfolio way back in 2017. So you could say that we are early, but I think now we're starting to have some peers who are doing the same thing. So I think that's a very powerful tool if you think about it, that each and every one of us involved in investment, you think very hard because not only is it for the corporate good, but also it affects your personal compensation. So I think this is one of the things that demonstrates that we actually seriously mean business in this aspect. And in terms of initiatives on carbon, as well as the overall ESG. I mean, obviously ESG is a huge, broad topic, and there's so many things to talk about. But if we stick to climate itself, just to share as an example, so we talk about our investments in green, sustainable energy. So we did 18 billion Canadian dollars, and now we're at 36 billion. And our target is to do 54 billion by 2023. So you can see that we are really speeding up the whole process of doing so. I'll stop there because I can go on forever. I should let the other panelists have a chance.
Yeah, thanks, Wai Ling. I think we're going to move on to talk about some of your investment and also your new refresh climate strategy later on. So for now, I'll pass on to Gabriel.
Cheers. Thanks, Jane. For me, looking at the slides and seeing what's happening in the region and in the report, what really resonated with me was around the shift towards a more structured approach towards climate engagement. And I think that we're seeing this through portfolio tilting, through voting practices and elements that are actually starting to hit the ground. So moving from sort of a framework perspective to more of an implementation perspective. And for me, that was something that really stood out from the data. And that really resonated with what I've been seeing in the market. And I'm not preaching to the choir here with the people on the call, but what I find really interesting is the shift in engagement from corporates and also from countries regarding climate over the last few years and the extent to which that's increased. And if we look at some of the progress report that from AIGCC and some of the examples of Climate Action 100+ and the net zero commitments that are starting to come out, when I moved to Hong Kong in 2014, if you told me that these companies and countries would have net zero targets, I would have laughed and said, yeah, good luck, you're a little bit optimistic. So it's great to see that shift. And within that, one of the really interesting further developments we're seeing is the emerging focus on the S pillar within climate transition and focus on just transition. And from my side, this is absolutely critical for Asia, not only because we've got more than half of the world's carbon emissions, but because if we think about industrialization in aggregate, we're behind the curve of where the globe is on this element. So how do you improve that economic growth, development, poverty alleviation, and all the fantastic things that go with it, while actually meeting and transition away from carbon intensive fossil fuels? And so for me, that's an element that is really coming up the agenda. I think that tension between those two objectives are perfectly summed up within the Sustainable Development Goals, which I've spent way too much time looking at. So forgive me if I go off on a bit of a tangent. But if we look at SDG 7, I find it really insightful that the first indicator under SDG 7 is access to electricity. The second one is reliance on clean fuels and technology. And so that's basically, for me, sums up the entire challenge of what we're trying to achieve in Asia. And if we step back to more of a corporate perspective and what that means for us on the call and what we can do, My personal view here is that it provides huge scope for engagement and actually coming up with country-specific and company-specific solutions which are going to be appropriate for the environment that we're dealing in. And so there's no one-size-fits-all for the region. And for me, that level of focus on engagement and focus on transition and being aware of what some of the negative impacts of a very rapid transition might be on economic development, while also maintaining a commitment to rapid decarbonisation and finding that balance is coming up the agenda of the discussions that I'm seeing in the market.
Thanks, Gabriel. And personally, being involved with AIGCC's Asian Utilities Engagement Program as well, definitely just transition is rising in the agenda. And so really happy that you touched on that as well. So last but not least, Michael.
Yeah, thanks very much, Jane. And I'll just say a thanks to Beck for calling out the long title. It's a big territory. It deserves a long title. I'd also like to take this moment just to congratulate AIGCC. With the uptake in members, 60 asset owner and investment manager members in a short space of time, and for running this survey and producing the report. The results are very informative, and I suppose in some case the momentum has been surprising, positively surprising. So well done to you, and well done to all the investors for participating. I think that's already a sign in itself that this is important. And what did I take away? I followed on from Gabriel. He calls it a shift. I'm going to call it a seismic shift. A seismic shift in the rapid uptake in net zero across multiple stakeholders. I look at the report and I say 85% of the respondents with targets or considering targets, net zero targets for 2050, that is. That's enormous. That's huge. For the audience here, when I think about net zero, I think about it as something that's relatively new as a concept, and yet we're all adopting it very quickly. So, if I think about what that means when people are filling out, yes, net zero target, or yes, thinking about it, the challenge here is, what does that mean? What does it actually mean for your business? 2050 is a long way away. And what about the shorter term targets? And how's that going to be achieved? And, so when I'm discussing this with the clients that I work with, these are the questions that are keeping the C-suite of these organizations awake at night, and the people who are responsible for their ESG and climate strategies. Are they following a pressure that they need to do this, and how are they going to ensure that they're able to follow up on this action? And so, when we're looking across the region, it's almost got to the point where ESG is now, or certainly around net zero, the momentum is unstoppable. We've got, with net zero commitments from countries like China, India, Japan, South Korea, New Zealand, Australia within the region, and I'm hearing reports of up to 90% of the world's GDP now has net zero commitments. And we can see that it's critical for the companies that are working within these economies to have to contribute to that outcome as well. We're also seeing from these companies action, though. So, while I'm surprised at the percentage, 85%. I am confident in what I'm seeing when I talk to these clients around their activity to analyse their exposures, especially on the asset manager and asset owner side. Looking at science-based targets initiative around their frameworks for analysing financial institutions and how to approach that. That's relatively new as well, and yet we're seeing financial institutions adopt that. So the demand for reporting around TCFD aligned climate risk analysis and opportunities is growing faster than we can resource it, for instance, right? So that's a sign in itself. And I mentioned TCFD there. I want to make that connection that a lot of the way TCFD framework analyzes climate risk and exposure for an organization also provides the basis for net zero, such as a baseline, such as looking at scenarios, such as applying the same scenarios in an organization's own target setting. So really pleased to see these results. I think it demonstrates, the climate emergency that we're in. It demonstrates that Asia is no longer a laggard when it comes to adoption of ESG, and it's appropriate given the exposure that Asia has. And Gabriel called out the carbon emissions content, but we can also look at the physical risk that Asian operations face from climate-related physical risks, and we find that Asia-Pacific corporate assets are at highest risk from climate change in a 2050 sensitivity-adjusted physical risk assessment relative to their global peers. So Asia needs to take notice, because as global temperatures rise, the frequency and intensity of these physical risk events from climate change increase.
Thank you, Michael. I actually want to pick up on what you mentioned, the seismic shift that we've seen in this field, and especially in Asia. We did see from the report that we're expecting to see huge amount of product launches in the climate space from the investment side. So over 40% of survey respondents indicated that they're looking to launch up to 5 solutions in the next 2 years. So of course, then greenwashing becomes a potential issue and something that I wanted to pick up on. So Wai Ling, asset owners actually expressed in the survey that they have challenged finding external managers with an established track record in climate-related investment, and also concern of greenwashing. Do you share this concern?
Yes and no. So for us, it's kind of, I always joke about it. So first of all, if I just stick to public equities, because that's where the numbers are significant, because obviously for private, investments, equity or infrastructure, it's very, very bespoke. And so we will have the opportunity to evaluate on a one-on-one basis. But with public equities, obviously our holdings is a lot more significant. And part of it is it's actually managed in-house. And part of it, we have actually selected external fund managers to help us manage and invest in public equities. So when it comes to selection of fund managers, first of all, for good reasons or bad reasons, we have never selected managers who say that I'm going to launch an ESG product, or I'm going to launch a certain thematic. We actually don't quite buy into that. We buy into are you a value investor? Are you a growth investor? Are you a quality investor type of thematic? But what we have done is that because we don't really work with a huge number of managers globally, so we actually do quite a detailed and very careful fund manager selection process that can really last from anywhere between 6 to 12 months. And that's given that you already have some track record to begin with. But the whole process of it could easily take us anywhere between 6 to 12 months, obviously focusing on returns. But in addition to returns, we looked at not just climate, but total ESG. So we use tools, for example, from the International Leadership Network, ILN, which is co-chaired by CDPQ. So we use tools like that to do a preliminary filter for our external managers. So, and once that's done, so assuming they pass that preliminary filter with questionnaire, etc., we will actually have operating partners, do the actual due diligence himself or herself. And that again could take a couple of months just to satisfy ourselves that what is completed in the questionnaire, we could actually calibrate it and make ourselves comfortable that the fund manager is practicing what they tell us that they are doing on paper. And we repeat that cycle. So once you become a fund manager, we don't stop there, obviously. So, whether it's every 12 months, 18 months, 24 months, we go through, that evaluation again in terms of the exercise. So that's how we do that.
Thanks, Wai Ling. It sounds like a very thorough process indeed. And I think what you mentioned as well really argues for fully integrating ESG or climate into all your processes, right? So not just specific buckets of ESG or thematic out there, but really across the board, whether it's value or growth funds that you have. So also, the other side of greenwashing is frameworks and tools and guidance to kind of help navigate this. So I wanted to go to Gabriel's, where Beck and Fergus also mentioned that investors are embracing international frameworks, and Fidelity International joined Net Zero Asset Manager Initiative, which AIGCC support, and that was launched in December 2020. Can you comment on the target setting process and the interim targets that you have, and how do we make sure that these are credible?
Yeah, sure. Thanks, Jane. And this really does just build on Wei Ling's comments, because from my side, if we're thinking about setting targets for ourselves, we clearly need to hold ourselves to the same standards and level of integrity that we would anticipate from a corporate that it comes out with a net zero target. And for me, when I every time I hear a corporate say, hey, we're going to be net zero by 2050, my first thought is, yeah, no one at the company will be around to deliver that. So that's a pretty easy commitment to make. So the comment around interim targets, what you're doing on the ground and the tools that you've got to achieve it, and the transparency start to become critical, as well as the governance structure over the top of it to give it credibility. So for us, we have firm level targets for what we're trying to achieve in terms of committing to a 50% reduction in our financed emissions by 2030, as well as being net zero from our own corporate emissions by 2030. So we've got that firm level direction of travel. And what we're actually doing at the moment is going through a process of setting fund-specific targets for the funds that are within scope of our net zero commitment. And so what we're looking at for that is we have an internal tool, which is our climate rating tool, which is there's a little bit more information on it as a case study in the report if people want to dig into it. But basically what we're trying to measure is the net zero ambition of an issuer, their climate governance around that, and then how they're allocating capital. And so for us, that gives us an idea of how companies are positioning themselves to transition. And then what we're interested in doing is engaging with the companies that are towards the bottom of that spectrum to try and improve their performance. But then also for our target setting, we're going to be going through a process on a fund by fund basis to set levels of AUM that need to be in the top buckets. So it's essentially to set an ambitious target for changing the shape and profile of what's within that fund to be more closely aligned with net zero. The target setting is taking place starting this year, and we're going to be setting targets every 5 years on this point so that we can track the trajectory towards achieving those targets. We're also going to be doing fund level reporting on carbon footprinting for our funds so that people will have a transparent view as to how we're tracking on these commitments and how we're actually moving towards those goals. So for us, it's really those individual components. It's the ability to have transparency on how we're moving towards our targets. It's providing the tools and the capabilities internally in order to be able to measure and monitor that process. And it's also trying to tie it into real world decarbonisation and action. And we might get to this later, but for me, there are 100 different ways that you can decarbonise a portfolio, many of which aren't really having much of an impact. It's kind of shuffling deck chairs as opposed to actually trying to drive real world impact. So for me, that the way that you achieve those targets is as important as the target itself.
Thanks. Just following up on the climate rating system that you have, because we touched on it and it's a case study. I mean, it's pretty prominent that only 6% of Asian companies are assessed in your top 2 ratings. So when you talked about just now that funds have to have, companies with high ratings, how are Asian funds going to be able to do that?
Yeah, so this goes to the first comment that we actually made around focusing on transition, not where you currently are today in terms of looking at the potential for companies to shift. So what we're basically going to be doing is trying to shift that 6% northward. So we clearly want to be able to have much more companies in the universe and in the investment space that are achieving net zero or aligning to net zero. But if we look at investment universes today, don't think anyone on the call would disagree that there are actually very few companies that today have their business model in order and are actually achieving net zero within the region, outside of a few pockets of renewable companies or some exceptions. And so for me, what that really highlights is that any pathway towards net zero alignment for a portfolio genuinely has to be encouraging that transition and trying to move the dial around the current landscape of issuers within the market. And so for us, we believe that an engagement-led process is critical to try and achieve that, to have clear expectations, clear metrics around what success looks like for some of the issues, sector-specific elements and metrics where we can provide guidance and help people along that journey. But then also the other critical component of it is that we believe that divestment in this case is more of a representation of the failure for engagement to move the dial. So it's not what are you doing today that we're most concerned about, it's can that business model transition? Do we believe that there is genuine scope for enhancement and improvement? And that's what we're really trying to drive. And so what we're hoping is that the portfolios shift due to being able to move holdings towards those higher categories, but where our engagement is failing to have any impact and we still think that companies have their head in the sand on this, then those companies will start to exit portfolios.
Thanks, Gabriel. And turning to Michael, I think over the last 10 minutes, we already mentioned carbon footprinting, printing, tools, data, like multiple times. So clearly what you are providing is really important to help with the next stage of investor decarbonization. So can you comment on the lack of tools to measure green impact, one of the key barriers in the report? Perhaps you could comment on that and any other developments you might be seeing as well on the data front and tools. Thank you.
Yeah, thanks, Jane. And so I spent a bit of time thinking about what to say on this in a very short amount of time, because there's a lot to it. And so as I flicked through the audience, I recognized a few people that I know probably, they've been working in this area and have a lot of experience around data and tools, and some that I didn't know. So I thought to start this right at the beginning in terms of what data and tools are. So for the audience here, if you're thinking about, right, what am I going to use in order to assess my portfolio through the lens of climate resilience, starting right at the top, you've got data, which can come to you, or reporting services, which can come to you. You can self-serve using data, which is provided to you through platforms or through data feeds, or you can have a third-party expert source provide a report. There's pros and cons to each of those, right, in terms of your resources, the confidence that you can have in the numbers. When you're publishing those numbers, we tend to find people start with a reporting service and then move to data once they become more confident and resource themselves. That whole resourcing your teams is an issue at the moment. There is a big demand for ESG people and a big demand for ESG people who have knowledge, and finding that intersection of ESG people who have knowledge on ESG and an understanding of finance is a very small part of that Venn diagram, if you like. There are tools available, right, in terms of data, sophisticated tools that integrate ESG measures of companies, as well as having financial and fundamental and asset level data in the same spot. I mean, when I was talking to audiences in Asia 10 years ago about ESG, really ESG was a side plate to the story. Now the systems are bringing these together. You have no excuse as an analyst to be looking at these climate change metrics, especially those that are being called out as being material by the regulators and exchanges in the countries that you are operating in. And these tools also cover equity, as Wei Ling pointed out. That's a really important materiality or part of your portfolio exposure, but it also covers fixed income, listed equities, private equity, commercial real estate, and some of those have higher exposures to climate change. Commercial real estate, for instance, right? The buildings you've got today, the buildings that you're going to build tomorrow, because those buildings will be around for another 30, 50 years, they're going to be impacted by the physical risk. So the tools are there to measure these. Data is available at the company level from companies. So companies are disclosing and reporting more. Unfortunately, it's still not very standardized, but there's organizations such as ours, which take that data and standardize it, which spend a lot of time making sure that data is comparable. And then there's model data where you take that signal and you apply it to a framework like a science-based targets recommended approach of sectorial decarbonisation, the SDA or GEVA approaches, and you model that data and you create a scenario and a pathway which can then be used by you as investors to assess where you're at. Like I said, one of the things around net zero is that it's very aligned with how TCFD is reported. So a lot of people might be looking at TCFD and net zero and thinking, oh my God, I've got to do so much. But no, there's a lot of overlap between the two in the way you report data through TCFD and the way you think about your net zero journey. And it really is a journey, right? Don't think that from this one discussion or from ticking a box that 2050 you're going to do something, that it all happens and that's it. It really is about calculating a baseline, right? That's your carbon emissions on your portfolio today, making sure that's a robust calculation using current thinking, such as applying models like PCAF, the Partnership for Carbon Accounting Financials. Carbon footprinting's changed. It's not like it was 5 years ago, right? A lot of people think that it's done and tick the box, it's all over and we're happy and we know how to do that. The whole concept of carbon footprinting has evolved so rapidly, and the purposes and the use case for it has changed. So keep that in your mind as well. We need consistency. You're like, I wonder how many people who ticked net zero target today or net zero target in the near future actually think about the scenarios that they're going to apply. Because if everyone's applying different scenarios, then it's actually not useful, right? Because we're all going to be engaging companies on different scenarios to achieve different things, and companies are going to be going, oh, you know, Gabriel asked me to do this, Whaling asked me to do that. I thought, you know, everyone's trying to achieve net zero. So, you know, some consistency, some getting together, and some of the networks that have been called out on this help this kind of discussion, getting together. AIGCC brings people together to discuss this and to help for that consistency. The data is being used widely, right, by organizations such as ourselves. It's being applied to indices. One of the ones that I particularly call out is the the carbon efficient index, because not only does that index do what it says, but it promotes disclosure. And we want companies to be disclosing, because what companies disclose comes from them, and it's really powerful information to have, and we can use it in multiple ways. I'm going to take Gabriel's quote here. I should be giving it to him, but I'm going to use it because it's in the context of my discussion, Gabriel. This comes from him. He says, if you're not telling the story, somebody else will tell it for you. Quote Gabriel. It's true. Companies need to report, or it's going to be modeled. And well, I think our modeling is the best modeling available. You know, well, it's still not going to have that insights that a company has when they're calculating it themselves. That data as well goes into ratings. So companies can't avoid having an investor look through a climate change lens when they're looking to finance a company, whether it's, as I said, through equities, through a fixed income, a loan, because it's going into the credit rating and credit risk assessment, or through a private equity. So, you know, you can't escape it. It's here, it's happening. The momentum is shown by your own survey results. And then I feel like I'm going on here, but really just want to say one more thing, Jane, is that there's the deep technical expertise in areas like power stations, valuation of power stations, new areas like green hydrogen, pricing green hydrogen. You know, so Commodity Insights is one of the first organizations at S&P Global to put price benchmarks on green hydrogen. You can't actually have a spot price yet because it doesn't really exist, but we can still price the production of that. Zero carbon steel, carbon markets, voluntary carbon units. These are all going to become bigger as the demand for net zero grows, and without trying to promote any organization, you know, the organization that has that voluntary carbon exchange that's about to launch in Asia is CIX in Singapore, the Climate Impact Exchange. And last but not least, the taxonomies that are going to unleash the capital into investing in low carbon solutions, because it's going to be easy for investors to say, here's what I need to invest in order to be classified as green, and all my investors are measuring me by how green my investments are, my capital expenditure is, and here's a way that I can do that and decarbonize in a way that is being recognized.
Thanks, Michael. I think there's so much that we can talk about. It's impossible to cover them all here. I'm sure people will follow up with you bilaterally. I just want to encourage everyone to post your questions on the chat box if you have any. I don't see any yet, so I'll continue. So just talking about the great amount of new products coming in, and also seeing a lot of innovation, of course, which is a very positive thing. Just keen to explore that a bit further. Gabriel, you mentioned real-world carbon reduction. So just flipping back to you there, and what you're seeing in terms of the different approaches and how do you actually measure the success?
Cheers, thanks, Jane. And I'll try and restrain myself from teeing off too aggressively on the topic because it's something that I find super interesting. And if you dig into the data on it, you can geek out about different ways of decarbonisation in a lot of detail. But basically, if we think about real-world carbon reduction as the end aim of what you're trying to achieve, there can be different levels of alignment to that based on what your strategy is. And so my favourite example of this is that if you take global indexes, as highlighted by Climate Action 100+, the emissions concentration is pretty extreme within those indexes. So it's the 80-20 rule where 20% are actually contributing 80. So you've got the inverted data there. So what that means is that you can actually get a huge decarbonisation relative to a benchmark or an industry by removing a very small number of issuers from your investment universe. And so if you're looking at if we look at Paris-aligned benchmarks or transition benchmarks, sometimes they have a metric of a 7% annual reduction or decarbonisation versus a benchmark. You can typically achieve that for most benchmarks by removing 2 to 4 issuers every year from the benchmark. So hypothetically, if I wanted to demonstrate that trajectory of decarbonisation, I could do it with a minimal constraint on my investment universe and the way I'm actually operating and running a fund. But on a reported basis, look like I'm achieving significant decarbonisation each year. So for me, that's one of the sort of investment universe, playing around with the investment universe. The other element is by sector composition. And so as everyone knows within ESG ratings and portfolios, if you look at the composition of funds that have high ESG scores, sometimes these funds are literally just technology funds or issues that have less exposure naturally to material adverse negative externalities or carbon. And the question there is, by shifting allocation of funds on a thematic basis towards different sectors, are you actually contributing to decarbonisation in the sectors you're avoiding? And so from my perspective, there are a lot of ways that you can look good on paper without actually having any real impact. The other really interesting component here is the role of offsets and whether they're genuine, the quality of the offset, but then also where it's applied. So is it applied because you've found a great company that you think's got really good alpha potential, but they happen to have lots of carbon emissions, so you just buy some offsets to allow you to participate in that business? Or is it where you have a business where there's no technical ability for that business to decarbonise yet, but you believe that they're a critical part of the economy, and so you remain invested in them to try and encourage the adoption in the future, and because they're a systematic or important value chain for economic development or within other operations. So cement is a classic example within that. Where it's critical for a lot of renewable energy technology and infrastructure build-outs for adaptation, but at the same time in itself, there aren't really very commercial solutions. So for me, again, this is reflected in the EU taxonomy in terms of allowing the top energy efficiency of that segment to be classified as green. And so again, I think that we have to be very nuanced in terms of how we're considering the achievement of decarbonisation, especially with the raft of products that will be hitting the market with net zero alignment, with Paris alignment. For me, the critical question is, and this goes to Wei Ling's point, is how are you doing it? How is that tied into your strategy? How genuine is it integrated into your approach as a manager? Or is this some quant bolt-on that you've essentially retrofitted to an existing strategy in order to hit certain KPIs and targets? And I said I wouldn't go on a monologue, and I lied, so apologies.
No, that actually really ties in really well with what I wanted to move on to with Wei Ling as well. Who
no, but before you come, ask me questions, but I'm just, very, very intrigued by both Gabriel and Michael. I'm actually trying to visualize putting two of them together with my colleagues sitting in Montreal. There's a group of, significant number of individuals who does this on, as a day job. So, they are the ones who are actually looking at files, looking at data, collating data, challenging data to make sure that all of these numbers make sense. So I can actually visualize, the two of you having passionate debates and discussions with my colleagues.
I'm sure we can connect them.
We debated at length about what's the difference between carbon output versus carbon intensity, and what are the different measurements of carbon intensity. And, my eyes were just glazing over. And I'm like, guys, you do this for a living, don't you? And they say, yeah, we do that. And yeah, so.
I think we'd need another panel session to go through those metrics, but they are fascinating. I'll have you know, that's as the teaser. It is a super interesting topic.
Yeah, I mean, in the interest of time, I just really wanted to touch on with Wai-Ling with you as well about what you're doing on the transition finance and blended finance, because I think that ties in really well what Gabriel was saying about real world practices.
Sure. I mean, there are two initiatives. I think, following up on what, Gabriel is saying, that I think we struggle with it quite a lot internally, I must confess, that, with all of these carbon emissions. So what are we going to do with companies that are fundamentally good companies, but are very heavy carbon emitters? And so we decided to put aside a pocket of 10 billion Canadian dollars to finance transition. So, and it can be in any country, it can be any type of transition, not just project-based. But so the way I think about it is that, fine, for example, pesticides that are used in agriculture, it is actually heavily carbon emitting. So are there alternatives, for such pesticides, as an example? And we'll be happy to look at such opportunities. Same thing with cement, while the building may be certified a green building, but the materials that have gone in the building may not be, that green. So, same thing with, sustainable cement. So this whole $10 billion bucket, it's still work in progress. We've allocated that, but it's something that we are very open as well, learning on how do we actually finance this transition. But when I talk to a lot of my peers, I think a lot of us have the same ideas. And so to me, if it's enough of the sovereign wealth funds and the pension funds with sizable AUM, if we have the same ideas, I'm quite sure that we could help move the needle when it comes to transition. Oops, sorry, that's one. And two, blended finance, it kind of, it is not solely about transition, but then the concept of blended finance is actually not a new concept, right? So, but the idea is that it takes a lot to finance what is traditionally very difficult to finance projects, particularly in frontier markets and developing markets. So the idea is that, yes, there's PPP. So, there's private, there's public, but I think we need to move beyond that. So all of the, multilateral development banks, think of all the World Banks and ADBs who traditionally, and IFCs who traditionally have very good experience, with frontier markets and developing markets. They know the landscape best. And also to bring in, for example, philanthropy. So just to give everyone a context of what I'm talking about. So we're trying to pilot a $1 billion program where we and another bank put in, 80% of the money needed. And we would have an ADB-like institution put in 20%. But we're looking at working with a foundation, a philanthropic foundation, to put in, 75 million. And why 75 million? It's basically to tackle the risks which all of us financial investors will not be able to take. If we take those risks, then the risk reward of these projects just doesn't make sense. But if we can overcome this hurdle of these very difficult to manage risk with, for example, philanthropic money, then potentially we can actually be the catalyst to put money into very difficult to finance investments in different parts of the world. So we're looking to try this out and see whether we can pull this through.
Thanks, Wai-Ling. In the interest of time, we did get two very good questions. So I just want to jump to these two very quickly. Gabriel, I think the first one is for you. I don't know if you see it in the chat. but specifically asking about how you do everything that you talked about. There's a lot there. Is there any tips or specific things you want to refer to in terms of your workflow and organizational structure, how you go through that whole process? And then I think the last one will be for Michael as well. In terms of the barriers, can you share the best practices in the market and what kind of additional tools need to be developed for measuring climate impact, which is one of the key barriers? And then we'll have to have a hard stop, I think. Thank you.
We have 4 minutes, and that's about a 20-minute response. So I'll try and condense it as much as possible. So if I think about what are the important building blocks to achieve what we're trying to do at Fidelity International, I think that, and then what are some of the resources that can help you along that journey or to try and find out the best way of achieving it yourself. For me, the first one, it has to start with firm governance and buy-in and commitment to what you're trying to do, and for genuine impact and real-world outcomes. And so if you're doing it from a marketing or product-led purpose as to how can we figure out something that meets these characteristics, you can come to very different outcomes depending on if you're saying how do we actually result in decarbonisation through this product. And so for me, that governance mindset and approach from investment teams and ESG teams is a critical kind of foundation for moving forward. Within that, the clarity and understanding of objectives, what you're trying to achieve, the integration into fundamental teams from ESG, sharing of expertise. I completely agree with Michael's comment around the Venn diagram, the ability to combine both parts of the diagram and to make sure you've got the right capability, both on ESG and investment expertise, so that you can have a product which is genuine on both sides and meets the dual objectives. The other side of it is that if I shift, that's kind of the framework, enablers, foundation part of the question. The other side of it is tools, data sets, and what you need to make it work on a practical side. I would not try and reinvent the wheel here. There is so many good tools, data sets, guides present in the market, whether it's TCFD implementation guides for individual industries to let you know what matters in that sector, whether it's areas like the NZAMI approach towards decarbonisation and the different ways that asset managers can go about it. There is a huge amount of literature on this space, and carbon data is one of the, even though Scope 3 data is still challenging, it's one of the better data sources that is available broadly as well. So the data is there, the tools are there, the interpretation of scenario analysis is still a nightmare, but you can get a long way along that journey of understanding the characteristics of your portfolios, what commitments you should be making and what it should look like, from a lot of the data tools and items that are available. And AIGCC has got great resources on this as well, and all of the studies and everything there. So for me, those two parts of it is really the critical element. And then the final part is, how do you tie that together? So how do you ensure that after all of the resources you've looked at, you're creating something and having a solution which is going to fit the investment culture and culture of the firm, so that will actually be implemented genuinely? So if you've got an ESG team in an ivory tower that's coming up with a bulletproof climate strategy, if the portfolio managers don't like it or think that it's rubbish and they can't implement it, then there's a question as to what will be lost in translation from the ideation through the implementation. So that level of integration, combining those 2 points, is critical as well.
Thanks. Sorry, running out of time, Michael. Very, very quickly on measuring climate.
Very quickly. Yep. So key barriers for the clients that we're working with is to realise that it is a journey. You don't have to bite off the whole, apple or pie or cake in order to start. Understanding that the data is there and wanting transparency around that data. The experience within the organisation, as Gabriel called out, realising that there's support, educating that team, getting support across your organisation. The recognition that climate change is real, it's happening, it affects everything, everyone, everywhere. It's a critical part of the strategic long-term profitability of the company. It's not just something you do. And so having that recognition throughout the organisation, and a framework like TCFD does help do that because it is standardised. And then last but not least, identifying and using robust, credible, standardized scenarios. And I'll call out the AIGCC paper, Confusion to Clarity, which was published last year. That's Confusion to Clarity. It was Australian focused at the end with regulators, but it applies to everyone. The first 3 chapters apply to everyone, whether you're a company or an investor. Read that paper as a way to understand the benefits to you as an investor and a company of incorporating climate risk having mandatory reporting. I'd love to say more, but I'm going to keep the time. So I'll stop there. Thank you.
Well, we're only 1 minute over. So I'd just like to thank all the speakers. I thought the discussion was really interesting. And thank you everyone for joining today as well. And we look forward to connecting everyone and talking further. Thank you for everyone's time today.
Thanks, Jane.
Thank
Thanks,
you.
everyone.
Thank you.
Thanks. Thank you.